Good day, fellow investors. A few days ago we discussed how the financial markets are ready for reckoning. However, we also discussed how to invest, that you are rewarded from what you own, not from stock prices always going up or interest rates always going down. So there are a few strategies to touch on that. And then there was this great comment how now is the time to buy Kraft Heinz. And that's completely correct. We are looking at the best 5-year opportunity to buy Kraft Heinz. Plus, if you look at the numbers, the P ratio is 11, the dividend yield is 6%, and in my last video about Kraft Heinz, when the dividend yield was just 5%, I said that at around a P ratio of 10-12, this is getting interesting. So let's make an analysis, and if the 6% yield is sustainable, perhaps even growing, it could be a very, very interesting situation. But first, let's have my assistant describe the business.
Besides ketchup that is enjoying growing demand?
Well, in effect, you're asking me whether Kraft Heinz is a good buy, and we don't want to give information on marketable securities like in that manner. But yeah, there are a number of items besides ketchup that enjoy growing demand, and some vary quite a bit by geography. There's enormous differences in the penetration of various products in the portfolio. Consumer packaged goods are still a terrific business in terms of return on invested assets, and but the population worldwide grows fairly smallly and at a fairly minor rate, and people are going to eat about the same amount, and there is some more willingness to experiment, or go for organic products of the sort. It's a very good business, and there are new products coming out constantly. It's not one where you're going to get terrific organic growth, but it never has been. And I like the business, and we own 26% of it. But there are a number of items within Kraft Heinz that enjoy fairly healthy growth. And I think you'd find that at most food companies, and I think you'd find very good returns on tangible net assets at those businesses.
Thanks, Warren. And speaking of Warren, tomorrow I'll give you a video that might surprise you on Buffett. Back to Kraft Heinz. Where do we put this on our quadrant? Let's first discuss the business and see whether it fits the quadrant. Recently, you all know Kraft Heinz, Heinz, Philadelphia, Kraft, all those food brands. The situation has not been good. Organic net sales down 4.7%. That's a big hit. Earnings are down a little bit, and free cash flow is flat. If we look at what's going on, okay, Easter impact, but something is not going well with Kraft Heinz because these are huge, humongous hits. There is something structurally wrong with the market, or is this just temporary? They are doing these Lunchables, they have issues, some things do well, some things do bad. They have all these brands, mac and cheese and things like that, mayo, but the key thing is that competition is intensifying, and perhaps the customer today is not that connected to these brands anymore, because if I look at my kid, for him ketchup is ketchup, he doesn't really care what the brand is. And that's different from when we were kids, for example, where brand really meant something because it was different. Now everyone, even private labels and everything, can make almost the same quality. And that is then reflected here, how even on volume, they try to increase prices and the volume is going down, especially in North America. So that is something to watch. That's the key market, of course. And now the key question is this temporary? Will they be able to turn that around? What happens if not? What's the valuation? They are investing in price. They're not investing in price. They are lowering prices because the competition is destroying them. So you can call it whatever. And then they are optimizing their marketing spend, but in order to compete on higher prices, maybe they're doing the marketing and then you go to the store and then, oh, let me try this, and then it's still very good from another producer. However, for investment perspectives, the cash flows are still there, earnings per share going down a little bit, but they have stabilized their leverage, they're investing in organic growth, managing their portfolios, things like that, but also returning capital to shareholders in various ways. There is the dividend and there are also share repurchases. When you top this up, that is a significant return to shareholders. So the thing is that the outlook has been worsened, that's why the stock is down, and the key question is whether this is something temporary or it will continue. Let's look at the presentation conference call to see what the analysts are asking, what are the key issues. The CEO says how growing market pressures in the first quarter, they did great in line, blah, blah, blah. Improving brand superiority. The thing is that this is not yet reflected in the financial results, and the question is where will that be reflected and if. Guidance cut, of course, shocked also analysts, and that is the key there. If we look at the guidance cut, their outlook was flat to down and now it's for sure down. Everything is less nice than it was, except for cash flows. They are trying to manage that. Now, the key question here is Kraft Heinz has been different than other companies, larger food companies. Other companies are managing to show better numbers, show good returns to pre-pandemic levels, and that is something that Heinz hasn't yet done, and that is the key worry here. But talking about analysts, when the stock was high, their target was always above, and now that the stock is permanently down, they are also lowering their targets. When the stock was high, nobody was telling it was a sell. Now everyone is telling you it is a sell. No more buys. Look at this. Everyone had it as a buy, but that's how analysts work. If we look at the financials, still, there is $3 billion of cash return to shareholders. That's 10% buyback and dividend yield. So if I put that 10%, and let's assume no growth, no nothing, there is, I think, risk from competition, questionable competitive advantages, brand value. So I would put Kraft Heinz here at a 7, 8, 9% return to shareholders. Maybe some private equity firm will come in, maybe some activist investor will come in at these levels, but also private equity is now under pressure, so that is also a big question mark. To me, these companies here have a larger margin of safety because they are not so pressured by the competition. It's not that easy to replicate. However, ketchup and all those things are easy to replicate, and in this environment, perhaps the market is changing. So I think that Kraft Heinz is looking attractive, but if I would be more certain about the long-term trajectory of the business, about the competitiveness, about some, let's say, positive structural tailwind, that I simply don't see. And that is where the stock is priced now. It can get even worse because the world is changing. The world is not the world from 25 years ago. Where would you make a TV commercial, brand mayo, whatever, and it would do great? That has changed, and it seems that Kraft Heinz hasn't found the solution. We are seeing this with many great brands, Nike struggling, things like that. The key question is the world changing? Maybe yes, maybe not. I don't know. I just don't want to take that bet. So this is investing. We look at 1,000 investments, 990 are no, 9 are maybe, and 1 is yes. Thanks for watching, and I'll see you in the next video.